What's going on, everybody? Samantha Growth here. I am LTV educator and partner with Chance on the Swipe Trades app. And today I'm going to go over how our risk management strategy works and our trading rules. So the first thing that we're going to go over here is how you figure out your risk management. So I have a couple of formulas here that you're going to use all of these to figure out what is the best lot size at the end of the day that you can use on your trading account. So the first thing that you need to figure out is what 2% risk management of your account is. So that's that second formula I have listed up there. And how you figure that out is you take your account size times 0.02, and that equals the dollar amount that you are allowed to risk per trade, still using my 2% risk management rule. Now, from here, you can figure out how much money you are risking on a trade by taking how many pips that your stop loss is times the lot size dollar value. So how you figure out the lot size dollar value is you take whatever your lot size is and multiply by 10, and that equals the amount of money you are risking. Now, those two formulas should equal the exact same number if you are doing this correctly. So you want to make sure those two answers match with whatever that you choose, because you want to keep to that 2% risk management rule. Now, from here, how you figure out what lot size that you can use is you take the amount of money that you're allowed to risk, so what should be the value up here, divided by the number of pips that you are placing your stop loss as, and that equals the dollar value of the lot size you can use. Now, to convert that into the lot size that you can actually use so that you know before you even go into the trade how much money you are risking and what slot size that means is you take the dollar value of the lot size you can use and divide by 10, and that equals your lot size. Now, this is something that I really recommend everyone do before you even sit down to the charts. Do this on a weekly basis. Go in, say, oh, my account is this size. Do all of this math and have it written up. I personally have it written up what lot sizes I can use from a 7-pip stop loss to a 17-pip stop loss. They're all on the whiteboard in front of me in my area where I trade. So this is a really great thing to have done beforehand. It makes your life so much easier. Now, from here, I'm going to stop sharing real quick, and then I'm going to reshare my screen. So we're going to talk a little bit more about risk management, because I know everyone kind of struggles a little bit at first when it comes to risk management and their rules. So these rules right here are rules that Chance and I have in place, that we do not break these rules or we have to do our punishment that we each have for ourselves. So these are the majority of our rules right here, and I'll go through and talk about each and every one here. So the first one is to avoid trading correlating pairs. Now, correlating pairs are, say, for example, GBP USD, GBP JPY, and GBP CAD, because they all contain the GBP. And the reason that I want to avoid trading all three of those at the same time is because if I place trades on all of those, I place a buy on all three of those pairs, and I am wrong about what the GBP is going to do, I triple down on my losses, which is not something that you ever want to do. So I avoid trading correlating pairs. My other rule is I only ever risk 2 to 4% of my account per trade. Now, you saw at the beginning when I was talking about the risk management how you can calculate what that is, but that is another rule that we have. The next is to have a specific trading time. Our specific trading time is London session. To us, the Forex markets do not exist until London session opens at 2 a.m. Central Time here in Illinois. The next rule is to take half of our profit once our trade risk reaches 2 to 1 risk to reward levels. So what that means is, let's say, for example, I use a 7-pip stop loss. When my trade reaches 14 pips in profit, that is 2 to 1 risk to reward, and I will take half of my profits, because you guys all know that we twin trade. We always do the math and know what we are risking before we ever place a trade. That is an absolute must. You never want to be surprised when a stop loss hits by how much money that you did lose on that trade. It should always be math that you did before you entered the trade, and that's why I recommend you guys all do the math so that you know exactly what lot sizes and everything that you can use on your account. and not have to do the math right before you're entering the trade. It's so much easier to just look up at a whiteboard and see, okay, I can use this lot size because I'm using this stop loss size. I have a 6% shut off percentage. And what this means, for those of you who don't know what a shut off percentage is that if I lose a certain amount of trades in a night, so since I risk 2% on every trade, if I lose 3 trades in one night, I close the computer, I go to bed, I just walk away, come back tomorrow with a clear head ready to trade again. But 6% is where I just stop trading. And that goes into another rule that I have here is don't revenge trade. And these two go hand in hand, because once you become an emotional trader, let's say you were buying Euro USD and it went down and hit your stop loss, and then you got really, really upset, so you sold Euro USD because you're like, oh, it's going down, and then it goes for the buy position and it hits your stop loss again. When you continue to do that, that is what we call revenge trading, and that is absolutely a terrible idea, guys. Take it from me. We did it at the beginning of our Forex journey, and just do not do it. It costs you so much money. It never goes your way, and it is just not worth it. Another rule that we have is to always have our charts marked up and ready before we actually sit down to the charts to actually trade every day. You don't want to be coming in, let's say 1:50 Central Standard Time, because you're getting ready to trade. You should be in the mindset that you're just ready to watch your charts, let them go, see what they are going to do. You don't want to be rushing through trying to mark up your charts the last 10 minutes before the session that you're going to trade, because at the end of the day, that just gets confusing. You will miss trades, and it's just not worth it, guys. That next rule that we have there is you only trade 4 pairs each. We recommend you guys all trade 3. We currently trade 4, but that is all we will trade. And Chance trades 4 pairs, I trade 4 pairs, and that way we can each keep track, get to know our pairs, learn pattern recognition, because at the end of the day, that is what Forex is pattern recognition. And guys, from that, our rules go into when we will enter a trade, which is off of a break and a retest. What we do after we enter the trade, which is do not stare at your charts, guys. You don't want to just sit here after you enter a trade freaking out about whatever it's doing. Watch it go up, watch it go down, watch it go up, watch it go down, and drive yourself crazy. Relax. Understand that this is a process. It's going to happen. It will go into profit eventually if that is a winning trade, but just by sitting there and watching it just tick 2 or 3 pips in one direction, 2 or 3 pips in the other direction, it will drive you absolutely crazy. So you need to learn to have that discipline of what to do once you're in the trade. But from there, guys, thank you so much for watching this video. If you guys have any other requests for videos that you would like to see, please let Chance or I know. And I will see you all tonight on IML TV. Hope you all have a great evening, morning, day, wherever you are in the world. We appreciate you so much, and we will see you on the next video.